Good afternoon, everybody. Welcome to Trader Merlin Show. It is your Wednesday Hump Day edition. It is the FOMC rate day, which, of course, is the most anticipated event of the week, maybe even the month, just because of its impact for the broader markets. And as Dogbone says here, the Powell pump, yeah. I mean, look, he has a miraculous way of moving these markets. And what's interesting is, as that announcement came out, we actually saw some pretty not sharp, but the whipsaw that normally follows that type of announcement as the market spiked to the downside. And I'll bring that up here to start our show. Let me get my charts all ready because clearly I'm not prepared for today's show. Let's go into a 5-minute time frame. Actually, let's do a 1-minute time frame just to watch when that announcement came out. And lo and behold, there's your 11 a.m. So you saw it initially spike down aggressively, then ripped up. And really, as expected, the moves really started happening after Jerome Powell spoke. So from the moment that the announcement came out till the press conference, the market had moved up. I'll give you exactly a number here, about 0.25%, 0.25%, no big deal. Now, from the time that Jerome Powell spoke to where we are now, we saw a better gain to the tune of right where we are, and then let's go to where the market's closed. Another 0.5%. So all in all for the day, up 1.07% for the S&P 500. All in all, I'll take it. Good market move based off of what I think is a pretty lackluster FOMC statement. Now, the good news for everybody here is that Bill Addis, who I consider to be the bond king, he will be joining us tomorrow to talk about the FOMC statement, rates, interest rates, all the different things that deal with bond markets will be covered in depth tomorrow. Now, I'm going to go over some of the stuff today that I thought was interesting, and a lot of it boils down to Jerome Powell's expectation, the dot plot, which, of course, as I should be prepared, I don't have that one up for us, but I will get to that one here in just a second. But let's start things off with some of the numbers and data that Powell mentioned. Of course, we know they have a dual mandate, which is full employment and stable pricing, meaning make sure that there's jobs and make sure that inflation is not out of hand. And those two things have been big question marks for the past few years as there's been wild fluctuations with both of those numbers. Well, at least with inflation, jobs has been actually relatively constant. So let's go and start things with your unemployment forecast. I'm going to leave this up here just a little bit longer because I need to get a graphic ready, which I was clearly not prepared for, and I want to make sure that I have this all set for you guys when we get to that topic. So on the discussion of unemployment forecasts, there, of course, is a lot of speculation about where jobs may be going forward, and that leads us to Jerome Powell's statements. What I found interesting, at least from my perspective, was looking at this summary of economic projections with regards to their forecast for interest rates going forward and where they think inflation will be and other market metrics. So now that I got my graphic all set for you, let's go look at the numbers. So Jerome Powell said, of course, citing the current data, that right now we're at 4.1%. And maybe I'll bring up our numbers just to drive this home a little bit better. We're at 4.1% currently on the unemployment rate. Now, the question is, how high are we going to get? Where will we be in, let's say, 6, 8, 9 months? And I'm definitely in that camp of thinking we're going to be much higher. Let me ask you guys, what do you think we will be by the end of the year? Let's say at the end of the year, some of you probably heard Jerome Powell's, but I'm just kind of curious to think what your expectations are as to where we will be from an unemployment rate in the United States December 31st, right? Going into the end of the year. And while I dance around telling you what Jerome Powell said, I'm waiting for you guys to type in your responses because, ultimately it's just a matter of opinions. And ultimately time will tell who's going to be right or wrong. But I think your outlook on where this market may be certainly is going to be driven by unemployment, inflation, growth, etc. So Savas is 5.3. That would be a pretty big jump, especially, I'll bring the chart up here for you so you can kind of see it. Lisa heard Powell, so she knows the number. I'll leave this here so we can kind of see the higher numbers from the tail end of 2021. If we get up to even 5%, that's significantly higher. Like, we have not seen numbers up at over 5% since 2021. So that'd be a 4-year span since we've seen it. Oliver says 6%. Man, I'll tell you what, Oliver, if we get to 6% by the end of this year, that's going to be an crap moment. I mean, that's going to be one of those ones that really is like, whoa, we have some problems. That certainly is something that no one at this rate has seen coming to that extent. Les says 5.5%. I'm kind of with Big Eb. I think we're going to see a 4.6, 4.7. I think what you'll see is no big spikes, right? I think what you'll get is somewhat similar to what we witness here. And for the viewers or for the podcasters, I'm showing the unemployment rate in the U.S. going back to April of 2024. We were at, in April, we were at 3.8. And then the next month in May, we jumped to 3.9. Next month, we jumped to 4%. Next jump, we jumped to 4.1. And then we had a little bit of spike to 4.3. I think we're going to see something similar to that, just kind of maybe step up 0.1% each month, and maybe one of those will be flat. So I think you're going to get to that kind of 4.6, 4.7 mark here in the middle. Now, of course, as is supposed to happen, Jerome Powell and the FOMC trying to paint a little bit of a rosier picture. And their job is to make us feel warm and fuzzy and not have a moment of consternation or freaking out. And that was a consensus from the voting FOMC members of 4.4%. Now, 4.4% would be the highest level that we have seen, again, going all the way back into November of 2021. The last time we were even remotely close was August of last year. We came out at 4.3%. Personally, I think that's a pretty conservative number, but it does tell you that they generally feel that overall we're going to see slightly higher. Kind of like what Liz is saying here, slightly higher, but not massively. And yeah, I don't think it's going to be massive. I don't think this is going to be like this type of spike where we had from COVID, where it just went parabolic in no time. No, I don't think that's coming. Remember, this machine that we are all a part of, this economic machine, whatever country you're in your own economic machine over there, which is influenced by our machine, right? It's that watch analogy I like to use. One piece will impact another, and that has slow change, and that impacts another. I think the overwhelming theme that I gleaned from the press conference with Jerome Powell is just the level of uncertainty, which we have talked about here at length, so I won't go into that anymore. But he says, it's really hard to forecast where things are going to be because there's just too many unknowns. So I'm not going to even go there. So 4.4% is what the FOMC members are forecasting for inflation for the end of the year. One notable piece there, and we talked about this as well, he made a point that wages are increasing faster than the rate of inflation, which we looked at that when we got our CPI number last week. Guys, remember I brought up a chart there that had a graphic that showed wages are actually increasing. Let's see if I can bring it up for you just so we can bring it up one more time, because some of you may not have been watching that show, but I thought that was a really interesting chart when you could see that inflation was actually outpacing the unemployment numbers. So here is, earnings. So there we go. There's your graphic. I'll make it bigger for you guys. You can see earnings increased 4%, while inflation overall only increased 2.8. That's a 1.2% delta in favor of earners. So that's, kind of an unspoken thing there, but that is really important. So as long as inflation is rising, that's one thing. But if you're making more and outpacing the rate of inflation, that's obviously a great thing. And for markets going forward, if this continues, that mutes a lot of the impact of inflation. If people are making more money, then that's being eroded from their purchasing power of their dollar. So this is great. I certainly will be keeping an eye on this one going forward because, first off, you guys know I don't trust all the data, but I'm curious to see how this gap will be filled. At some point, I think you're going to see earnings start to decline here and inflation start to tick back up, and we'll probably cross over somewhere around that 3 to 3.3% mark within the next 3 to 6 months would be my guess on this one. So thank you, Yahoo Finance, for adding earnings to this one. Very interesting number, and it was interesting to hear Jerome Powell speak about that today. Not only the government, corporations in general are looking for efficiency savings by decreasing labor, right? I mean, we've brought this up before when we talked with Don Fron about robotics and AI. If I'm the CEO of a company, I'm hiring somebody who's an AI efficiency expert and saying, I need to look through my company and find out where I can improve significantly, not only in a productivity perspective, but also from a cost basis. If I can implement a software an AI software that's going to do, 5 times as much work for a quarter of the cost, I'm sorry, this is business. I gotta look out for my bottom line here. So yeah, I think you'll see a lot of that, and that will probably come forward here in the next few months. But wanted to share this graphic with you just one more time until we get our next one, because February's numbers look great. Other than that, auto insurance and prescription drugs, not too bad. I mean, heck, earnings are almost outpacing rent. That's impressive. Rent was only 4.1% increase for the month of February. I'm sorry, year over year, not for the month, but this is year over year growth. So 4% for earnings, fantastic. All right, what's our next piece that was discussed? Obviously, jobs was an important one, but inflation was the other big story. And this is where I think we're going to get just huge the funnel of probability, if we had a bell curve here, is just going to start to get really wide with regards to what the possibilities are, whether we have a sharp spike down in inflation, meaning getting towards deflation, or a big surge up. That bell curve is going to get real wide here. Right now, sitting at 2.5%, the expectation from the FOMC members were that we're going to get to 2.7 this year. So let me bring up our, I forget what week or month the core PCE price index comes out. So it's going to take me a little bit of time here. Is it next week? Is it core PCE? Yeah, I think. Let me run a filter here so I don't scroll and torture you guys with all my scrolling. We will remove all of those, and we're going to go all of these out and go to inflation. All right, so this should allow me to get to our core PCE price index number, which I think is next week. There you go. Based off this doesn't give me an annualized rate. This just gives me the monthly, which is 0.3. If we continue to see these 0.3s, then yeah, that would certainly solidify the Fed's argument or expectation that we're going to see 2.7 by the end of this year, and we're at 2.5 right now. What I found interesting was next year they expected to be 2.2%, which of course would be, if you look at a monthly reading here, that'd be like just 0.2, right? 0.2% there. I don't see that. I think they're way off on this one. If you listen to the press conference today, which I made it about 75% of the way through, a couple of the press people were saying, well, does this bring us back to a transient level of inflation? Which I had to chuckle at, because remember last time we heard the term transient rates of inflation. That was when they actually started to surge exponentially. So no, we don't like that word transient. Not a good term when we're talking about inflation. So they're expecting this to start to increase just a little bit, not tremendously. I do think that we'll be above 2.7% on the core PCE price index on a year-over-year number. Unfortunately, Forex Factory does not give me the year-over-year numbers. They just give me month-over-month. So what that means from my perspective is I think that over the coming months, probably not next month, I think that right now you can see our February number was 0.3. I think that you'll probably get a similar reading for March. But as we get into May, June, July, I do think you'll start to see this tick up to 0.4 or possibly 0.5, and that is going to skew their numbers. I think that the Fed's completely out of it. Saba says more lax QT. Yes. Yep, we went from 25 billion retiring to 5. So they were retiring $25 billion worth of their holdings, right? Taking $25 billion out of circulation each month as they expire. They've dropped that down to 5. So that's slowing things down with regards to removing money supply. That actually should have a positive impact on the dollar because there's less dollars being taken out of circulation. There's less dollars being taken out of circulation. We're going from 25 billion a month being taken out to 5 billion. Therefore, the supply still remains somewhat high, which would actually cause that dollar to slowly trickle down. And that may be part of the reason why we're seeing the actions that we're seeing right now. So yeah, more lax QT. What that means is instead of taking $25 billion each month and putting it back where they borrowed it from, they're only putting 5 away, which means $20 billion a month will be used to buy securities again, going and buying more, refreshing or replenishing those ones that have expired. So not as good, and I want to get a bigger breakdown on that with Bill Addis tomorrow because he knows much more on the details of kind of the unwinding of that balance sheet, both mortgage-backed securities and the other bond portfolio. Right now, their mortgage-backed securities still says $35 billion a month is what they're retiring there. So all in all, I think that's a good thing. The inflation piece, of course, for me is the biggest wild card. That's the one I'm just most concerned with because I do think that the tariffs are going to cause a big impact there. And it was interesting to hear Jerome Powell cited 4 main areas. He said there's significant policy changes in 4 areas this year. Number 1 was trade. Of course, that is being disrupted across the board. Number 2 is going to be immigration. Number 3 was fiscal policy. And number 4 was regulation. And he didn't elaborate too much on the regulatory side, but he talked a little bit about the fiscal policy. Just lets you know that these are major concerns for the central bankers. Therefore, they should be something we keep an eye on. Of course, we should watch those anyway from a trading and investing perspective. So if the Fed is not data-driven, then what is actually driving their decision? Well, they're still data-driven, right? They're going to be making their policy changes based off of what the data is telling them. Now, when we have the CPI and PPI numbers, they came out last week that were really good, showing deflation actually on one of them, actually no inflationary growth. That puts them in a position where they can potentially lower rates even more and stimulate the economy, which would be the ultimate goal, because lowering rates creates more jobs, creates more economic growth, and creates more inflation. So if inflation stays where it's at, then they're okay, got the green light to do that. So here's the dot plot, because again, it's three variables. The inflation side of things is the important one. So here's where the interest rate projections are for the FOMC members for this year. And you can see right now, a majority of them are at this 3.9 was the number that they gave. Remember, we are at 4.5 right now, which means at least 2 rate cuts by the end of the year. 2 rate cuts by the end of the year, and we'll see how that goes. But you can see here that 2026 is showing you a rate forecast of looks to be right around 3.5, and then your average seems to be down around 3.25. So consistently dropping over the years. Of course, this is always how it looks. They always seem to have this rosy outlook on the future, and of course, getting back to a normal of under 3% seems to be their longer run target for the Fed funds rate. Sure, great. As someone who might be looking for the long-term investments, great, this could help you. Personally, I don't believe anything in the second, third, and fourth columns. I have no interest in this on the second, third, and fourth columns. It's just, to me, I don't think that you could possibly forecast what's going to happen in 2026 given all the changes that have happened. Even I think this 2025 forecast is still pretty crazy. So what does that leave us? Well, let me go back to remove all our filters here and show you what happened for today. But boom, here is today's activity. There's your FOMC statement saying right at 4.5%. And the good news is, I believe it's the right path, is just to stay in a holding pattern right now at 4.5%. Just stay there until we see the needle swing one way or the other, right? One way or the other. Totally, Lisa. I think if you're trying to anticipate where the market's going to be in 2026, that's a crapshoot. Just way, way, way too much uncertainty at this point. It's bizarre how off these market forecasts can be. And by the way, I know I'm supposed to do this every day now. I was supposed to start the show by saying, for those of you who like the show, hit that like button. And if you're new, hit that subscribe button so we can watch the show every day. Big Eb says 70% of U.S. GDP is services. Tariffs have little effect on that. Tariffs are goods focus. Well, I've broken down the GDP like that, but thanks, Big Eb. Good to know. Well, that is interesting. I have to take a step back and think of how that might be impacted. I mean, right now, services aren't being tariffed, right? It's manufactured goods and service typically. So, all right. From there, there's one other thing I wanted to look at, and I'm trying to remember what in the heck it was. I forgot. Oh, well, I'll leave it there. So, all in all, I thought it was a pretty decent FOMC statement. The market, I think, expected this type of number. They were feeling really confident in that one, and, the summary of economic projections, I think, is a little wild to say 3.9 by the end of the year. However, what does the betting money say? That to me is the ultimate question. Where is the money being made on this one? Where are the traders making their bets? Let's see what they think about 3.9% by the end of the year. Right now, we are looking at in between 3.75 and 4. So 2 rate cuts, there's a 37% chance of that happening. There's a 28% chance of 3 rate cuts happening by the end of the year. And those numbers didn't change today. We'll see if they change tomorrow as the market's going to digest this and filter in a little bit. Oh, thanks, Gilbert. Well, I love that you're here enjoying the show. Love that. All right. Let me go into a couple other weird little topics today. So I'll go into the markets, but to do our review of the top 8, but I want to cover a couple interesting things. I want to get your take on it. I actually thought about doing a whole show on this because this to me involves a lot of discussion from you. I think it would require us to think outside the box. And I mentioned this the other day, which is these credit card caps. So AOC, which I know some of you love her, some of you hate her, AOC and several other members, and this is a bipartisan issue, not just Democrats, but Republicans as well, are looking at this issue of credit cards as being usurious, as being like literally legalized loan sharking, which in my opinion it is. I don't think there's any reason that someone should be paying 36% interest rate on their credit cards. So AOC now getting some support from President Trump as well, because he did talk about this during the campaign trail, is capping credit cards. So the rate that they can charge you and capping that at 10%. Now, at face value, I'm going to say this. At face value, I love it. Screw Visa and MasterCard. They shouldn't be able to make this rampant profit off of people trying to get by. They should be capped at 10%. However, I'm curious what you guys think would be the impact. If we capped our credit cards at 10%, what do you think the impact of that would be? Again, every action has an equal but opposite reaction. In some cases, the reaction may be even more intense. So let me know in chat. Type in what you guys think could happen if all of a sudden Visa, again, who has a lot of people carrying balances. I actually had a really good stat here. Let me see if I can bring it up for you. Unfortunately, I closed my mail. I had to email it to myself. The amount of people that are currently carrying a balance is kind of shocking to me. It's a lot. Let's see. I'll read you the numbers here. About half of credit card accounts, so about 50% of the credit card accounts have a revolving balance from month to month. For me, as someone who's in finance, I just gotta smack myself in the head. Go, what is wrong, people? Are you that financially destitute? 50% of all credit cards have a balance on them? I mean, come on, from month to month, meaning you're not paying it off in full. Boom, mind-boggling, right? 13% of cardholders make only the minimum payment due. Ay, ay, ay. 13% of those people, you will never get out from debt. Never. Okay, so let's see. What do we got here? I'm going to read the comments through for the podcasters can hear it. What was the unemployment number? The unemployment number right now is 4.1%. The expectations are 4.4 by the end of the year. Let's see. It might have the opposite. Andre says it might have the opposite effect. Less credit availability. Less credit available. People to continue to spend more. It would cut spending and hurt consumer discretionary. Less available credit. Yes. That's it, guys. That's really it. Lee says that would encourage the fiscal irresponsibility of people even more. It won't make a difference to those of us that pay off the credit in full each month. Totally correct. So if you bring down this mechanism for credit card companies to just pilfer from the average American, the credit card companies are going to be now much more selective in who they offer credit to. So, I've got an 800 plus credit score. So for me, the credit card company is going to try to entice me to use their credit card at all costs. They show me like 24% max rates, but if they look at the numbers, they know I'm never using my credit card. I'm never carrying a balance on any one of them. So I'm not a target for them. Who do credit card companies target? They want people who have low credit scores, who are using credit cards as a mechanism of earnings, right? For them, a credit card is money, and they need that money to get by day to day, to pay rent, goods and services, and things like that. So if you go to somebody who is financially less fortunate or more, let's say, is financially irresponsible, their credit score is probably going to be in the 5s or the 6s. And for that, the credit card company is saying, you're a risk to us. We need to charge you more. Now, maybe it should be more tailored to, someone's credit worthiness and credit score. That's driving the importance of the credit score. But look, if you cap credit cards at 10%, there's going to be millions of Americans who will no longer get their credit cards. And that's going to, I think, have a significant impact on consumer spending. So while it sounds great, and I think it's a good idea to put some caps on it, maybe not 36%, maybe we drop it down to 25%. All right, let's do something that, in their lifetime they can get out from underneath. But if you cap it at 10, credit card companies are going to not offer credit to a lot of people. And that could really hurt them, not only hurt the economy because of the spending, but also those individuals who may rely month to month on credit cards to get by no longer have that emergency lifeline because they don't have a credit card. So while I think it's great on one front, I think there certainly could be some problems down the road with this cap idea. Maybe we find some middle ground, right? Not 10%, but maybe it's 20 or 25. So the credit card companies still have an incentive to, rip people off, but people that need it, they're absolutely surviving because of that access to lifeline of credit, can use it. So there we go. I don't think it will ever deny people credit cards. So many places are going cashless. I think they will, Lisa. So if I'm a creditor and I know I'm only getting 10% interest from you, but also there's a huge possibility that you're going to default on me. You're running a max balance and you're going to run away with, a $6,000 credit card balance. I can't take that. I can't take that. It's just too big of a risk for me at 10%, right? Just like for all of our trades, when you make a trade, you have a certain risk factor in your head. There's multiple risk factors, right? Number one risk factor when you make a trade is, what's the probability that I feel of this trade working out? That to me is what a credit card company is doing to some of these people, saying, what's the probability of you actually paying the minimum payments? And number two for me is my stop losses as a trader, right? What's my maximum risk exposure? Credit card companies have that as well. The maximum risk exposure would be the credit card availability balance, right? Is it $500? Is it $10,000, $50,000, whatever? So those balances might get very small and not be enough for those consumers to continue to live the way they do. Ultimately, what I think should happen is it should make all these people a little bit more responsible with their money, but that's probably never going to happen. There's some people that just don't understand the basics of money and how it all works. I wish we could get government-sponsored training. Like if you have a credit score of, I think this would be a good law. If you have a credit score of, let's say, under 700, then you should be required to take a class put on by the government for free. Government pays you to take this class, and it teaches you the importance of spending, budgeting, income, expenses, liabilities, and shows you how to get on track so that you're no longer being subject to this system of just usurious interest payments. How does that work in a cashless society? Well, it's not going to be a cashless society yet. I mean, we are a cashless society to an extent. They would be able to use a debit card, right? So they could use a debit card in a cashless society where there's money in the account. But again, a lot of them don't have money, right? So how would they buy goods and services? Is it a digital food stamp card or something like that? I don't know. I don't know. Credit card debt is unsecured. Correct. Whereas debit cards is secured. You can only use your debit card for the money you have in the account. Let's see. I love the transfer your balance and get no interest for a limited time. I think they still tempt people like that. Yep, yes they do. In one of those things, for those of you who might not have great credit scores, there's a website that I've used in the past. Again, this is no sponsorship or anything. Use there's many other sites, but there's one site called creditcards.com, which I think is great. To the point that Lisa is making, it's a great one. If you have a credit card right now that, let's say your maximum limit is $10,000 and you're carrying $7,000 on that thing, you're in trouble. Because not only are you carrying a balance that's very high relative to the available credit limit, which puts you at a negative score, right? If you're over 25%, some will say 30% of a balance, max balance, negative strikes on your credit score. So let's say you've got a $10,000 credit card limit and you have $100 on it, no impact to your credit score, you're fine. If you have $5,000 on that, you're now get a negative strike on you could lose points for that because you're over 30% of the maximum available credit. And the further you go, the worse it gets for you. So if you are carrying a big balance, you have these zero APRs. You can just click the right zero APR card here and it'll show you a whole bunch. So for example, zero APR on purchases, zero APR for 21 months from opening an account. Now, what you want to make sure is that transfers are allowed because this might be for brand new purchases. So here it says 0% intro APR balance transfer period for 21 months. So yeah, if you're carrying a big balance in your card and paying 23, 24, 25% interest, man, open up the card like this, move everything over there, and now you're going to pay 0% on that for 21 months. Just make sure that you set an alert that makes sure that when you get near that 21 months that this card is paid off. Because I think that there's some trickery with regards to balances for that long carrying, and I don't know how they will work it out, but make sure you pay this off in full or roll it into a new one. But yeah, great services like this for people to use. There's many different ones. 21 months for that Wells Fargo is pretty darn good. It's almost 2 years of interest-free money. That's great. Really, really good. Listen, but if you transfer the balance to an interest-free card, you still have to make the minimum payments. Correct. Yeah, you still have to make the payments. It's not like you can just let it ride. You have to make the minimum payments. But at least I know if I have a $5,000 balance and I make the minimum payment and there's 24% interest, I'm killing myself. But if I have a zero balance transfer fee and zero APR for 15 months, great. That's fantastic. I'll just make the minimum or try to do everything I can to pay down my other cards first and then pay this one off at the end. Yes. And again, as Liz says, it does assume that your credit score is good enough. Here you can see 670 for the Discover. You have to have 670 for the MasterCard as well. It looks like 670 is kind of your bottom line here, but there's all kinds of different credit cards out there. And I encourage people to take a look at this. Every now and again, you'll see some really amazing deals these credit card companies will issue to get business with them. So that was an interesting piece I think is kind of important for our markets going forward. That is a high rate card. It's a high rate card once you pass the time. So you can see here, there's all kinds of, it says 17%, 23, 28.99. That's once you get past the 21 months. Yep. So yeah, there are definitely high rate cards, but you're also getting interest free for 21 months. It's worth it. Just make sure you set, I have a calendar on Google or Google Calendar where I map out when I cancel my cards and start new ones. Because I do this. So I go here to the category and I use airline. And I'll scroll through here, and every year I'll do one or two. But you can see here it says 75,000 free miles. That's a free round trip ticket anywhere in the U.S. So I get a free trip anywhere I want in the U.S. Okay, great. $95 annual fee. Sometimes they waive the first year. So I like, $6.95. That's too much. A lot of them will waive the first year. So I do the ones where they waive the first year, give me some amazing bonus, and then I will cancel it in 11 months. 11 months. Everyone can find a card that fits their needs. Use them. Thankfully, these are things I don't have to worry about. I never have to spend. Yeah, exactly. Look, Lisa, I tell everyone this. I do everything with my credit cards. I spend all my money is through credit cards. And I pay my balances in full automatically, so there's never any interest payments at all. Just make sure you pay it in full. But why not use the credit cards? They're offering all kinds of perks. They know that the vast majority of people won't pay off their credit card in full, so they'll make money off the other people, not me. They're losing money on me and some of you. All right. Martin says, the only time I carry a credit card balance is if it's 0% interest for a year or more. Yep. And because then you can take that money from on that credit card balance and pay off something that's charging you interest, right? Absolutely. Last one here, and I think I actually brought this up. So once I finish this, we'll go back and look into the top 8 markets here, see what we did today, which is pretty exciting. I wanted to share this one with you because Trump has a pretty big speech tomorrow. At least I've heard this. I have not been able to see on their website if it's verifiable. As you guys know, I'm a big fan of digital assets. I think there's a tremendous future in digital assets and tokenization of anything of value. President Trump tomorrow is due to be one of the headline speakers at a digital asset summit in New York. Now, I'll read through some of the names here just so you guys understand. This is a no small, shady event. You got Representative Tom Emmer. We're talking senator from Minnesota. You got Caitlin Long, who's one of the sharpest minds in the financial world. You got the CEO of Solana. You've got Binance CEOs. You got Kathy Wood of ARK, Michael Saylor. You've got Mohamed Al-Arian, who's just one of the biggest brains in the industry. Man, he's phenomenal. And we're talking literally hundreds of other A-listers, not only in politics, but people running things like Chainlink here, Sergey Nazarov. I could go through this list over and over and over again because there are so many big people speaking at this one, and President Trump will be speaking tomorrow at this conference. Now, why do I bring this up? Because we saw some interesting things happening. Cynthia Lummis will be there as well. Let me make sure. I'm pretty sure I saw her on this list. Lummis should be there. Could have sworn I saw her on the list. Maybe I didn't. Oh man, the list is just absolutely massive. I wish I could go. It's pretty darn expensive to get ticket to this one. I could have sworn she was there, but I'm not seeing her picture right now. Let's go Control F and go. Oops. Let's go over here. Be Control F and then type in LUM. No, apparently she's not. Surprised. I could have sworn that she was gonna be there. Anyway, the reason this is important is. You guys are funny. It's going to be a huge speech. It's going to be huge. No one knows more about digital assets than I do. It's going to be great. It's going to be great. It's going to be huge. It's going to be a massive. It's important because I'm curious to see what his take is. Right? I don't think Trump is very well versed in crypto and digital assets. I do think he understands a basic understanding of it. Maybe he's way deeper into it than I know. But curious to see what that presentation will be. Tomorrow. What does he address? What does he talk about? Because that may give us some clues as to how the administration will build its digital asset stockpile, right? And anything I can do to get clues as to what that digital asset stockpile will be, that's benefit to me, right? So if he goes in there and he says, we need oracles and Chainlink is the best out there. It's going to be so great, huge. Sergey Nazarov doing wonderful things here. It was just wonderful. And he keeps pointing out Chainlink. I might load up on some Chainlink here because probably going to put that in that strategic Bitcoin reserve. So this will be an interesting one. I don't know exactly the time he speaks, but this is one of the bigger events in the world. Now, if we look at what's gone on with crypto over the last 24 hours, here is your futures market. Again, yesterday was kind of a surprise. Didn't think we would sell off like that, but if you look at the pattern that's formed over the past 2 weeks, this looks really good, folks. I know it's painful because we're down so much, but notice we're not making new lows. We're trending higher. There's like almost like a little box you could put around here where it looks like, let me take that off. I'm putting some lines on the chart here. Sorry for the podcasters, you can't really see this, but you've got like this upward channel here. And as long as it stays within that, I think you're going to start to get some acceleration, because what was driving this to the downside was a lot of fear. A lot of fear and just blatant selling. Now the fact that it's stabilized and starting to make higher lows here and slightly higher highs, at some point buying's going to come back into this and all of a sudden rip this to the upside. So Oliver would say that's a bear flag. It's actually not a bear flag, and here's the reason why it's not a bear flag. A bear flag would be something after a very sharp move. And I wouldn't call this a very sharp move. Like back here, I'd call these bull flags because you had a giant up move, slight consolidation, bull flag. Same thing here. And again, technical analysis is a bit of art. So for me, I would say not a bear flag. And if you're looking at it from this perspective, so I'm drawing from the peak that we had back here on January 21st, all the way down to the low we saw on March 15th, right? That's the range. And I think Oliver may be looking at that as the pole. Now, could we look at this on, let's say, a weekly? And does it change the picture? A little bit, but not really. I still personally wouldn't call it a flag. But you are correct, I think, in understanding the basics of what a bear flag is, right, Oliver? A bear flag implies weakness. And I would agree with that overall we still are weak. I'm not saying that we've turned the corner. I'm not saying that we're going to get this monster rally, but it does feel like for the first time we're starting to see some pressure build here, which could lead to higher upside movement. We're not there yet, right? For me, until we get above like 93,000, I still feel like we're kind of trending to the downside here for the shorter term. So this is encouraging. It doesn't mean that it's all over, but what will probably happen is the way that fear and greed seems to work with crypto is over the next few days, if we start to make some new highs, I think you're going to see a big surge and money just come pouring back into it. Now, remember, we've got this $500 million short position that's still looming out there. I don't know if that's been closed yet, but this has got to be killing that guy who's short with a 40-to-1 leverage product. The more this moves up, the more likely he gets short squeezed, and that could cause another big pop up here. So I'm definitely feeling optimistic and bullish on Bitcoin, at least in the shorter term here, based off this pattern. So that's a good thing. And of course, comments made at that Digital Asset Summit tomorrow could have a bigger impact on that. So I'm pretty excited for that one. Unfortunately, I'm busy. I was so busy this morning, I didn't even get a chance to buy a bunch of put positions because I was looking at buying puts on the S&P as we came into that overhead supply level. But we'll talk about that right now. How about that? Real quick, before I dive into the other markets, Martin says, if Trump understood Bitcoin, he wouldn't have left it out in the initial announcement of the crypto strategic reserve. He's being careful. He's got to be real careful, I think, with regards to digital assets. Tread lightly, but, I mentioned this morning in the XLT general session for Trading Academy, love him or hate him. And again, I'm not aligning myself either way here, but love him or hate him, he did do what he said he was going to do. And I made that point when we started off in January. I said, look, he said he's going to free Ross Ulbricht day one. He didn't do that. Took him about a month. Great. Free Ross Ulbricht. Said strategic Bitcoin reserve. Did that. Going to swap out some of the regulatory stuff and make it a little bit easier and support digital assets and crypto. He's done that. So, he's fallen through to his word so far, at least with digital assets. I'm not talking about everything, but just the crypto stuff. He's kept to his word. And, now that he's got DJT stock and he has World Liberty Financial, there's monetary incentive for him to keep juicing this industry and boosting it to the upside. And knowing that Bitcoin's his number 2 holding in World Liberty Financial, I think that you'll see more upside potential here for Bitcoin. So all in all, I think those of us who have suffered through this pretty significant drawdown here, the light is at the end of the tunnel, I believe. And now I think we could start that big run that we've been talking about for the year, which brings Bitcoin up to $250,000 by November. Fingers crossed. I think he left out Bitcoin and Ethereum in the first announcement on purpose. Well, I think he left those out because the assumption was that Bitcoin and Ethereum are his favorites. He already had those in World Liberty Financial's portfolio. So, maybe. Why did he do it? Why did he do the strategic crypto reserve or leave things out? Self-interest would be my... Number one, he did it because of votes. right? He knows there's a ton of people who are going to vote with their pocketbooks, and a lot of the younger generation have their money in crypto. So they're looking for the crypto boost, right? That's part of it. So pandering for votes. Remember, he was, in 2016, he was anti. He was anti. He called Bitcoin a scam. It was bad. I don't like it. He said. So he's definitely changed his tune. But I think, Trump, wow. I did not realize, but Trump has 6 fingers. 1, 2, 3, 4, 5. Yeah, he's got 6 fingers in this picture. Wow. Did not know that. President Trump's got 6 fingers. I think that he realizes there's a tremendous amount of money for him and his family to be making. So his family's setting up World Liberty Financial. He's got DJT as well. Self-interested. I think is a big part of it. When Bitcoin hits 250,000, I will sell my MicroStrategy stock. Yeah. If I still have it, then I'll sell it too. Didn't he free Ross you on his first full day in office? No. It wasn't his first day. I believe it took him, it was several weeks into it because a lot of people, like myself, were complaining about it. It took him several weeks into his administration. Cardano, a buy here. Look, Cardano, the reality is when we get a strategic or digital asset stockpile, which is the next shoe to drop, right, is what is going to be in that digital asset stockpile, which we have an executive order signed by President Trump that we're going to get it. What's in it? Well, Cardano, while I love Cardano and I love Charles Hoskinson, Cardano is tied to a Chinese development firm, which already, to me, puts it out of the category. Anything that goes into the strategic or digital asset stockpile is going to be U.S.-based. I don't think Cardano makes it in there. I think it's ties to China, and it's got IOHK, I think is the name of it. Input Output Hong Kong is the name of the company. Because of that, I think that does not get it included in a lot of the discussions. And I think that might be part of the reason that Charles Hoskinson was not invited to the Digital Asset Summit at the White House, is Cardano's tied to a Chinese company. Therefore, nope, not going to do it. Not going to do anything with it. I think. Just speculation on my part. Okay, so let's go through our top 8 here and we'll wrap up this show because how long am I? It's already 43 minutes in. So our 10-year yield had a nice spike down today. And I think this has a lot to do with the expectation of interest rates. Nice drop, but we're still between those 2 yellow bands on our screen here. For those that are listening to the show, right now your 10-year is going to be oscillating back and forth between 4.4% and 4.1%. So you got about a 30 basis point zone that this is bouncing back and forth between. We fell about almost 4 basis points today to 4.24%. That was your biggest loser, down 0.89. Russell 2000. Wait, why am my numbers are all off here. Gold. Gold continues its break. Love it. Continue to move to the upside. We've been waiting for a little bit of a pullback here. I was expecting it to happen at 3,000 and it did not. Never triggered the entry, which is this blue line. Today you have a similar situation. If you were following the gold price chart there, you can see it's not quite a hammer formation. Not quite. Shooting star formation. But I would put a line underneath the lows from today, which can be $3,031. If you get down below $3,031, I think you got a short opportunity here for gold. Again, you're going counter trend, which is a very dangerous thing to do. But I do think gold is due for a pullback here at some point. It's just been way too strong. I mean, green candle after green candle, lots of buying enthusiasm. So that was unchanged on the day. There we go. Martin Luther says, Bitcoin seems like a scam. He said in 2020. Yeah. And I think he said some other things in 2016 about it, but now he knows the value of it. Maybe he really truly believes in it, which I hope that's the case. I think he might be there. Or it's, how can I make money off this, right? How can I make myself some big money off it, which could be another big factor in this. So that's your dollar index, 0.22%. What makes me nervous about the dollar index is simply there's long topping tails. You have very small bottoming tails over the past couple weeks. It looks to me like the dollar is going to be just traversing to the downside and getting weaker and weaker and weaker. I don't remember why I had the 103 mark in there, but it's because it's the top of this demand zone going back to October of last year. So, yep. Weakness for the dollar looks like it's going to persist. Your crude oil today, a little bit of a green, a 0.24% gain, but I'm still bearish. I'm not going to change my tune here, so I could probably stop talking about crude oil because I'm still bearish on it long term. S&P 500, which was 4th place, we came up and actually breached that yellow supply zone I had drawn out. Right? The reason that box is there is it was a demand zone, which has been violated. We ripped up to it today. We're still in it right now, so it leaves everything up in the air. After yesterday's discussion about following through these steps, that was step 3, was retracing back in overhead supply, which it did. Step 4 would be selling off again and breaking that blue line at the bottom at 5,509 on the S&P. Didn't get that today. Right? We actually had a pretty nice rally of 1.07% for the S&P. Fantastic. There we go. Thanks. Yeah, my sinuses do feel a lot better. We'll see what happens after this show, because it's usually after I talk loud and long. It's just my voice doesn't like that very much. Here's your NASDAQ, even better, 1.27, and a lot of that happening because of what went on with the Magnificent 7 stocks. You look here, all Magnificent 7 stocks were up. Meta was the worst, only up 0.29, but you had Tesla up 4.68%. Google is up 2.2, Nvidia up 1.8. Good. I have puts on Nvidia, so if they don't get down to 112, fine. I'll collect that nice premium for the last 3-4 days. Your Amazon is up 1.4, Apple's up 1.2%, and even Microsoft up 1.1%. Now, on that note here, for those of you that like Apple, Apple looks weak. Even though you had an up day of 1.2%, it had a really long topping tail. And if we break this down into, let's say, a 5-minute time frame, you can see that there was an initial surge early in the morning and then just gave it all back. That's not a good sign. So something was clearly pushing this thing up. These huge green candles happened on a 5-minute basis on Apple this morning, but then almost all of it was given back. A pretty big sell-off there. That tells me that the sellers are really ultimately in control here. So keep your eye on Apple. That may be a continuation sale tomorrow for those of you who can trade Apple, because, of course, I cannot. All right, back to our top podium here as we get to the top of the list. Russell 2000 was absolutely fantastic, up 2.39%. The only real stopping point I see from like a technical perspective would be about 2,160. That's about a 60-point jump up from here, which is almost 3%. So Russell still has a lot of legs to move here for that retracement back up to overhead supply, but looking great. And then lastly, here's your Bitcoin, which you already talked about, a 4.14% gain on the futures. Spot's going to be slightly different than that, but all in all, a pretty darn good day for Bitcoin and crypto in general. Some of these crypto projects, up almost double digits. Ripple, by the way, had the case from the SEC dropped today. Really surprised it only bounced 9%. Right? The SEC has had a case against Ripple for years now, and they're appealing it, and then they dropped the appeal. So one of the things that's going to happen in crypto, at least from my perspective, is you're going to get this clean slate, if you will, where the SEC says, all right, get rid of all litigation. That was old legacy, old objectives, clear the plate, and now we'll regroup. And if some of those lawsuits do in fact need to be pursued, we'll start it up all over again. But let's just start from scratch, because we've been fighting this losing battle. If you look at what happened with Ripple, Ethereum, and other companies, even Cardano was named in a couple of these lawsuits. You have a project like Hex. Hex is a fraud. Hex is a scam. Hex is a Ponzi scheme. And I don't think I have it on here. Do I have Hex on here? I had it for a while, but there's Hex. So here's Hex. This thing should be zero. This should be literally bankrupt. It's run by a con man, Richard Hart. You research him and look at the guy. He is an absolute con man. And I don't know how on earth this is not getting shut down by the regulators, but hopefully this type of stuff does, because this is looks like it delisted. Oh, I'm sorry. This is not even there anymore. It got delisted from this exchange. So let me bring up Hex, H-E-X. Let's see where it's at now. It should be much lower. Crypto Hex, USD. Delisted. Let's go HEX. Because of the regulatory issue, Hex was delisted from a couple different exchanges, but I can't even find it. Maybe it is shut down. Good. Or maybe they changed the name. I know it was going to switch over to Pulse and different chains. So anyway, I think the SEC is going to come back and start lawsuits against some of these companies. All right, let's talk about Coinbase. So Coinbase, if you look at what's gone on, we can get rid of that little yellow box there. Coinbase has been absolutely slaughtered, as has most of crypto. If we go back to the highs from December 24th to where we closed at today, Coinbase is down 45%. Now, knowing that they're the largest exchange in the U.S. that's publicly traded, actually the only exchange in the U.S. that's publicly traded, I think that if you're a value hunter looking at the longer-term picture for cryptocurrency and digital assets, I think selling puts at, like, say, 160 or something is probably a pretty good idea. Or just going long on Coinbase knowing that you're going to hold it for some time. Because while we still could face some ups and downs, I think the overall implication here is up. And as Trump unveils the strategic or digital asset stockpile, and more people realize, oh, well, the government's buying this coin or that coin or the other coin, then I think that there is, better opportunity for those that are holding crypto, and I think that'll bring in more buyers for digital assets, and that means more revenue for Coinbase, and therefore I'm bullish on Coinbase. So I think down at this levels, Coinbase is a buy. Let's see, Just 10X asked about TradeStation. That was way back there, wasn't it? Let me see. What was the question about TradeStation? Sorry, I'm going to scroll back here and try to find it. Lots of questions. If you're still here, are you still here, 10X? Dang, I can't even find out where it was. You guys have had a lot of conversation today. I'm scrolling trying to find your TradeStation question, so my apologies if I'm going way back here. I can't find the TradeStation question. If you can find it, just post it in the chat for me. Not sure what the question was about TradeStation, so. Oh, swing trading with TradeStation? If you're swing trading equities with TradeStation, fine. I like the platform TradeStation. I have no problem with it. They were just charging a lot of money for the platform, which I got annoyed with, as long as it did over a certain amount of transactions. I actually still have it. I haven't been charged any fees, so I haven't used it, but I like it. I was always a big fan of TradeStation. I think that their technical analysis platform is one of the best out there. You can do so much with their platform, but like all platforms, once you get used to the functionality, the hotkeys, and utilize it for what you want, I think it's a great platform. Absolutely great platform. I don't have any of my brokerage firms linked up to TradingView, but I am debating connecting, some of my accounts to TradingView because I like their charts. I actually have become very familiar with TradingView's functionality, and I like their stuff. But TradeStation is a better charting package. You can pretty much do anything with TradeStation. TradingView definitely gaining on TradeStation's dominance on the technical analysis side. But yeah, that was my bread and butter for many, many years was TradeStation. I do like TradeStation's charts, and they had, it's just kind of weird the way you have to have separate options accounts, separate futures accounts, and equity accounts. It was weird that things were kind of partitioned like that. But I haven't had an account with them for several years. But yes, I am a fan. I did use them for, over a decade, and I have stopped using them a couple years back. Okay, let's go look at your economic calendars and other information for mañana. Obviously, the big stuff's out of the way with the announcement that happened today. Later on tonight, actually it should be wee hours of the morning, you have ECB President Lagarde will be speaking. That's going to be at 1 a.m. Pacific time, so most of you will be asleep. You also have the Swiss National Bank, which I find interesting because they're at 50 basis points right now. I mean, they're very, 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 very low, and now they're expected to drop another 25 basis points. So that's anybody's trading the Swiss franc. You also have the British pound we're reporting tomorrow before the markets open. They're expected to stay the same. And for U.S. data, we have unemployment claims, the Philly Fed manufacturing index, existing home sales, and natural gas storage are just some of the things happening for tomorrow. So do I use Thinkorswim? Yes, I have used Thinkorswim. I find I don't need it. It has too many features and functionality. So with Schwab, I could just use their basic platform is all I really need. I go and I find the price charts. I look at the premium I need. So I don't use the really complex platforms anymore. I find them just too, I hate to say it, cumbersome. So a basic order entry, you just give me a chain and a price chart, and that's all I need. I don't need all that other fluff and all the millions of different buttons. So I've been using actually the basic platform for options from E-Trade or Schwab. I just use the basic stuff, much easier. Thinkorswim is a fantastic platform, but it can also drive you nuts with its complexity if you don't know what you're doing. You almost need a special class just on how to use Thinkorswim. For tomorrow, earnings-wise, you've got Micron Technology, you've got FedEx, Nike. You also have Lennar, and those are your big ones. Accenture as well. I think I sorted by market cap here. There you go. Accenture, you've got Micron, Nike, FedEx, Lennar, Darden Restaurants, FactSet Research, Jabil Circuits, another big one, big name there. Now, Nike's of interest. I've mentioned this one before where I was buying Nike around $70, expecting them to have bounces, and they have. They've had just phenomenal bounces up and down from there. Right now, I'm looking at this going, gosh, do I want to sell puts on this thing tomorrow? I do think you're going to see Nike bounce up on earnings tomorrow. I think it'll have a pretty big earnings jump. I mean, it's still down off of its peak. I'm just going to go back a couple of years here just to show you the fall from grace for Nike. It's down 59% off its all-time high. I mean, this is not a shoe company that's falling out of favor. They may have made some mistakes along the way, but I still think Nike's a pretty darn good company. So it's right around $70. I'm a buyer of it, but they have earnings mañana, and that'll be after market close. Thinkorswim is the best. No fuss. Yeah. I like it, but I like the simpler stuff. Margaret, $5 shirt. You know it. Five Below. It's the only way to go. They've got a couple of good ones. I may have some new shirts over there, but yeah, this is one of my just grab a shirt out of the bin real quick and ended up wearing it today. Fresh sarcasm served daily for those of you listening to the podcast. All right, guys, that's going to do it for me. I hope you enjoyed today's show. Tomorrow, we're going to have Bill Addis on the program. If you like today's show, hit that like button. If you're new, hit the subscribe button and share it because we will be, I'm hoping to grow this audience a little bit more and maybe see if I can, ideally, I would like to get to the point where I could actually bring on someone to help me with the certain aspects of the show, but that means there's got to be money coming in for that, and there's zero money coming in for the show, so I got to get to a level where maybe that's the case, but it would be fun. I talk to other people who are running podcasts, and like, oh, I've got 6 people working for me. It's like, goodness gracious, I do it all myself, 100%. Anyway, if you have something you want me to discuss tomorrow, email me, tradermerlin@gmail.com. Bill Addis is our guest. We're talking bonds, interest rates, central bank, Fed, all that good stuff. I will see you guys tomorrow. Take care.